and also using the formula or the equation, non-outstanding balance calculation we discussed. Now we have to go amortization schedule. So before preparing the loan amortization schedule, there is a question. When periodic payment calculation, can you do this? Mal has obtained a loan 400,000 rupees to be repaid in 4 equal annual installments beginning 1 year from today. So what is the Mal's annual payment on this loan? If bank charges him 16% interest per annum compounded annually. So now calculate loan installment. So then we can prepare the amortization schedule. How much the annual installment? Now same similar question we did last week, so therefore you can apply the same formula and same way you can calculate the annual installment for this loan. This is the 4-year one. How much the installment? Did you calculate? Now you can do it quickly. So here the loan is 400,000. We paid in 4 annual installment. Interest 16% per annum. So we are going to prepare the amortization schedule to show how the loan is paid off over time. Before that, we should calculate installment. So what is the application here? Present value of annuity. Because for the present value of the 4 installments equal to the your loan, your borrowed amount or the loan amount. So therefore, we apply here present value of annuity formula to calculate the installment. Periodic payment or installment into 1 minus 1 plus r into the power minus n divided by r. So installment we are going to calculate here. Present value of the installment is 400,000. Or this is annual installment, so therefore you can take the 16% as it is. No need to give it to month. You are going to loan repay within 4 years, so it is 4 divided by 16. So how much the installment? How much the installment? Is there message? Not sure. Two hundred 50. Right. So this is your annual installment. So when you deposit this annual installment 4 years, at the end of 4 years, so your loan will be repaid. So now we are going to see how this loan is repaid over time. This is okay. Right? So we are going to prepare the loan amortization schedule. So loan amortization schedule is a table. It shows how a loan is repaid over time. So you know that when you are paying off the loan, so today you are borrowing 400,000. So this amount is reducing over the long period. So therefore, your interest initially for the first year, you have to pay interest on the 400,000, but in suppose in the year 3, so your loan balance will be different from the 400,000. So therefore, over the time, this is reducing. So your interest amount is reducing. So we'll see how a loan is repaid over time by preparing this amortization schedule. So normally loan amortization schedule, this installment, now this is an annual installment. It is an annuity. At the end of each year, you deposit this amount. This is fixed. This installment includes two components. One is the interest for the period, interest paid for the period, and loan repayment. Loan repayment. Right? So this installment consists of the two components. One, interest for the period, and the loan repayment for that particular period. Right? Even though you pay fixed amount at the end of each year, its values are different. So now we'll see with this example how we prepare loan amortization schedule for this particular loan repayment. So loan amortization schedule will be looked like this. No certain fixed format, but anyway, if your loan period is 4 years, there should be columns or row wise, 4 columns or rows. You can prepare the row wise also. If it is going to the 5 years, so you have to columns for 5 years. So likewise, your loan amortization schedule basically will include this information. Right? Basically will include this information. So what are these information? Beginning balance or the opening balance of the loan, installment. So we have calculated it, your installment, and interest. Interest amount for the years over the time, and capital repayment. So what is the capital repayment? So each year you are repaying the loan amount. So from the initial borrowing you are repaying certain amount every year. So that is the capital repayment. From the loan how much you repay, and then ending loan balance. So basically these informations are included. So now we are going to prepare this loan amortization schedule. See, here we have used only the 4 columns because this loan repayed period is 4 years. So therefore we need only the 4 columns. Let's see how we fill this. Now this is your loan amortization schedule. Year 1, balance at the start or the opening balance of the loan. Your borrowed amount is 400,000. Your loan at the beginning of the period, so this is the opening balance or the beginning balance of the loan, so that is 400,000 because you borrowed 400,000. So interest for the period. So you can remember here, interest is 16%. So year 1, interest yes, it is 16%. So year 1, so you are paying 16% interest on 400,000. So then you can calculate interest component for the year 1 on this 400,000. You have to pay 16%. So that is 64,000 is the interest component for the year 1. So this installment is 142,950. It is fixed. Throughout these 4 years, you are paying this 142,950. So then your loan is over. That is not changing. Every year, at the end of every year, you deposit this amount. Now in the year 1, interest component is 64,000. So your installment is 142,950. So in end of year 1, your loan repayment is how much? From the installment, 64,000 interest. Installment consists with the two components. Interest component and the loan repayment. So in the year 1, interest component is 64,000. So then loan repayment is how much? 142,000 only minus 64,000. So year 1 you repaid the loan 78,950. So that is your paid back on the loan. So then you can calculate ending balance of the loan. End of year 1, your loan balance is now from the 400,000, you have repaid 78,950. So your loan balance is 321,050 rupees. So that is the beginning balance year 2. This is the beginning balance for the year 2. So now for the year 2, how much the interest? Are we calculating interest on 400,000 now? Are we no, because we have repaid 78,000. So now bank calculating interest for this balance 321,050 rupees. For that 16% you have to pay the interest. So then your interest component for the year 2 is 51,368. So your installment is not changing, it is annuity. At the end of every year, you deposit to the bank 142,950. That is fixed. So then your loan repayment year 2 from 142,950, interest is 51,368. So you are paying 91,582. So end of the year 2, your loan balance is then from opening balance you have paid 91,582. So that is 229,468. Now if you are going to settle the loan, suppose that after the 2 years of payment you are going to settle down the loan, how much you have to pay? 229,462. So the same value you can take using the formula also. Now your timeline for this loan is like this one. So today you are borrowing 400,000. So that is the loan. This is 4 years loan. 1, 2, 3, 4. Your installment is 142,950. 142,950. So I think in the previous example we calculate loan balance using formula. So at the end of 2 years payment, after paying the 2 years, you are going to settle the loan. So using the formula also you can calculate it. So if you are going to settle the loan after end of year 2, so how much you have to pay? How much you have to pay? So there are 2 installments to be paid. Okay? Now 2 installments are there. So then present value of these 2 installments to the period. So then your loan outstanding balance to the end of year 2 is equal 142,950 into 1 minus 1.116 minus 2 divided by 16. So you may solve this, you will get 229,468. Same answer you will get 229,468. So using the formula as well as this amortization schedule, you can identify ending outstanding balance. You can check it whether you are getting the same answer. I am getting 229,468 here. So by looking at the table also you can identify outstanding balance. Same thing you can get from the formula also. Right. Now in the year 3. So opening balance is now 229,468. So bank charge interest on this 16%. So now it is interest 36,740. So your loan repayment is 106,235. So then ending balance now you can do it is 123,232. Now opening balance here for 123,232. So you are paying interest on that 16%. So your loan repayment for the year 4 is equal then 142,000. When you interest deducted from it is equal to the your outstanding balance. So now it is 0. The loan is paid off in 4 years. So that is the loan amortization schedule. If you look at this interest row, what you can see? If you look at this row, that interest payment row, what is you can see? Over the time, interest is decreasing. Why? Because interest is calculated on the reducing balance. Bank is charging interest on the reducing balance. Even though we pay fixed amount 142,950, bank calculating interest on the reducing balance. So what happens to the loan repayment over the time? It is increasing. At initially, bank is not getting back a large amount, but when the loan is going mature, so bank is taking back large amount. So it is increasing over the time. Interest component is decreasing over the time. So this is the loan amortization schedule. So you can prepare it for any period. So it shows us how the loan is repaid over the time. So simply you are doing 142,000, you are depositing to the bank. So this is what happening inside the loan. Okay? Any question? So it's okay, no? Right. Now I think this is end of the time value of money. Certain questions are there in your tutorial, but I think I have no time to discuss all the questions. Selected few questions I will discuss. Others you have to manage by yourself. There are 2 questions here. Alright, look at this one, first one. Quickly, yeah? So now you have learned everything in the time value of money. So now these are the applications. So quickly you have to go through these things. So then we are starting for validation. First one and also look at the second also. A used car sells for 7.5 million. The buyer of this car wishes to pay for it in 48 monthly installments. The first is due on the day of purchase. If 24% interest compounded monthly, find the size of the monthly installment. Same similar question. Within 2 minutes you can do it. How much the monthly payment? Used car sell for 7.5 million. By business to pay, this is 48 monthly installment. Interest required 24%. How much the monthly installment? So here, your loan 7.5 million. So again, the application of the present value of annuity. So loan amount is 7.5 million. So you have to work out periodic payment. But here, interest 24% per annum, compounding monthly. So therefore, 1 minus 1 plus R divided by M into M divided by R divided by M. First installment due on the day of purchase. What it gives you? So first installment has to pay immediately. So it means that this is a due value. So therefore, this is you have to multiply by 1 plus R. So that's all. So you can 24% per annum. So then monthly 2%. So 1 minus 1.02 into the power minus 48 divided by 0.02 into 1 minus, sorry, 1 plus 1.02. So that is you have to work out equal 7.5 million. How much this from? What is the? Is it 156,985? I think this is wrong because there is a mistake. So what is your answer? You get the answer? Make a value. 239,790. Look at the next one. I think you can manage this also by yourself. Jawardhan wishes to collect 1 million to purchase a land. In order to collect that money, he wishes to deposit 3,633 and 50 cents each at end of each month in the bank that pays 15% per annum, compounded month. After making the last deposit, he would have the desired sum of money. Determine the number of deposits. How many deposits that Javardhan has to make? What is the application? How to determine the number of deposits that he has to make to collect this money? Yes? What is the application? Here, all confident that we what is the application here? Huh? Which are your? I read it. What will be the application? You can draw the timeline. So you wish to collect 1 million, right? 1 million. To achieve this financial objective, you are going to make some deposit. So you want to 1 million in some future date for some requirement, right? To purchase the land. So you collected this money. You wish to deposit 3,633 monthly. 3,633 and 50 cents monthly in an account that pay 15% interest per annum. How many deposits? How much? How long will it take to have this 1 million? How many deposits you have to pay? The application of what? This 1 million is what? Huh? Future value of this deposits. So that application is future value of annuity. So you have to apply that formula. Earlier it was present value of annuity. So you can remember it. Future value of annuity equal periodic payment into what is the formula? 1 plus r into the power n minus 1 divided by half. So you can apply this 0.0125. So r here 1.0125 into the power n minus 1 divided by 0.0125. So we are making monthly 3,633.50 cents is equal to 1 million. So you have to solve this formula for n. So you can simplify this by 1 million dividing 3,633.5. Then it will be 275.21. What is equal 0.125 into the power n minus 1 divided by 0.0125. So then this is you can multiply by 0.0125. So then you will get 3,440 equal 1.0125 into the power n minus 1. Now you can solve it, no? So minus 1 you can take to this side, so then it will be positive. So then we will end up with the 4.440 is equal 1.0125 into the power 8. So here what that like? We can convert this into log. Okay? And convert it into log form. So therefore log 4.440 divided by log 1.0125 is equal to 8. Okay? What is now? Is it 100 and 120? Because it's something. Right. So there are so many questions in your tutorial also. All these questions now you can do. These are I think not difficult. All these you can do. You can do yourself without any trouble. All I think. Huh? I will look at these discussion questions only. Right? All other these questions you have to attempt as a group or whatever way. Because all we can't do. Similar type questions are there. Any questions? Do you have any questions? Right. So discussion questions actually on the discussion questions I will look at. If you look at this first one, what you can say? You can say, no? Nishadi expect to receive 100,000 rupees and she is indifferent receiving it today or in 2 years. Do you agree with her decision? She is indifferent having it today or in 2 years. Do you agree with this decision? No. Why? Now you know the concept, no? 100,000 today and 100,000 in 2 years are different because of the time value. Look at this one quickly. Gayatri obtained 25-year loan of rupees 15 million 11 years ago. She is required to pay monthly installment of 157,983 and 62 cents at an interest rate of 12% per annum, compounded monthly. At present, the market interest rate has come down, and Gayatri is planning to take advantage of reduced interest rates by settling the existing loan with new loan. How much should she borrow at the new market interest rate to settle the loan? Gayatri has obtained 25-year loan 11 years ago. So the monthly installment is given. So now the interest rate for the loan is 12%. However, at present interest rate has come down. So therefore, she want to settle this loan and by taking another loan. So you are asking how much should she borrow at the new market interest rate to settle the loan. But you have to calculate. For the exam, you will get the question like this. Huh? What you have to do? No need to have the answer, but if you know the way of doing that, that's fine. How to do? Advertising should do it. How to do? The mega 25 years loan has obtained 11 years ago. How many installments are there to be paid? Monthly installments are going. 25 years, 11 years ago has taken it. So then how many installments due? How many installments? 25 into 12, total installment is 25 into 12. Is it? Here. So, 300. 300. So, has obtained 11 years ago. So then now 11 years, throughout these 11 years, the loan has been paid. So then 11 installments mean 11 into 12, 132. So then remaining installment 168. These are the outstanding uh, installments. So now the interest rate has come down. So then you are going to settle the loan and by taking another new loan. So how much you have to borrow at the new interest rate? Loan outstanding balance at the end of 11 years. That is the loan outstanding balance at the end of 11 years. So you can calculate it is. So by applying the present value of annuity formula, so present value of annuity formula is application 168 outstanding loans installment are there. So installments value is given 157,983.62 into 1 minus 12% per annum. So then monthly 1%, 1.01 into the power minus 168 divided by 1%. That is the answer. Right. Right. So there are one, two, three, four questions, discussion questions. I'm paying attention to these questions because these are very, seems like very practical. So therefore, this one is okay. No? This question number three. Question number three. So I will make a four groups. So question number three should attend one, two, three, four. Right? Then question number five. Tundera. This one, right? Question number three. Then question number three, five. This one. Okay. Then this Jagat needs buy a car. This one. ඊළඟ row එකේ ඉතින් එතනද එතනින් අර blue t-shirt එකයි ඔය තුන් දෙනා last මේක ඔයාලා ගන්න this section එකයි ඊට පස්සේ Asila obtain loans this one දෙවෙනි එක ඊට පස්සේ ඔය කට්ටිය මේක සමාන එක Jagat needs this section last තුන් දෙනා then what is that දෙකයි තුනයි තුන් දෙනා ඔය Quindi, ragazzi, non so se vedo con le One of you from the group have to come and elaborate the answer. Don't take serious, huh? Nothing there for serious. Just simply come and see. Now it is time 1 o'clock, so 1:15 I will finish. Huh? Any question? Question marvel right? Hathara is अंतिम एक कटली है मैं कट्टी में कुमार this one ඊට පස්සේ ඔය කට්ටිය සුසිල right ඊට පස්සේ සමන් අනිත් තුන් දෙනා අන්තිම තුන් දෙනා ජගත් Any support? Finish? Shall we see the answers? You go. Five and Maximum 5 minutes, huh? One to one, yes, 123. So you have to finish 130 exactly. Finish, no? Right. Come. Who is coming to present answer? Now, I think others also now you pay attention to the questions also, right? Because all other questions are also important, so therefore pay attention to now the discussing question. Uh, don't worry about the calculations. Come. Question number 3. Number 3. I think better all should read the question first, right? Because you have to look at this question also. Please pay the attention to this now, right? Kumar celebrating 40th birthday today, and he is considering investment plan where he is required to make monthly deposit 7,000 starting 1 month from today and continue payment until 55 years old. After making the last deposit, no transaction will be made over the next 5-year period, but interest will be accumulated. Starting from 60th birthday, he plans to make 60 equal monthly withdrawals from the fund at beginning of each month. The funds earn interest rate 12% per annum compounded monthly. How much money will be accumulated in this fund on Kumara's 60th birthday? What is Kumara's monthly withdrawal? It is what?
After the 15 years, this will be.
So this is the answer for the part A. How much money will be accumulated from March 60th? Is it the answer that accumulated value, accumulated fund from Kumar's 60th birthday is? So what Kumar's monthly withdrawal? Monthly withdrawal 777. Finish. Right. Good. We'll see. Right. Thank you. So I think others can read the question, right? So I think the way you approach the question is correct. But if you draw the timeline first for this section, it is what it says like this. Kumar celebrating 40th birthday today. So this is his 40th birthday. And he's considering an investment plan where he required a monthly deposit 7,000 starting 1 month from today. Right? Starting 1 month from today. So today, 40th birthday, from today, 1 month, he's going to make a monthly deposit 7,000, by 7,000 until he becomes 55 years. Until he becomes 55 years. So then how many monthly installment is there? 15 years. 15 years into 12. Right. So then, after making the last deposit, no transaction will be made over the next 5 years. So then next 5 years mean after until reaching the 60 years old, no any transaction, but interest is compounding for this amount. But interest will be accumulated. Starting from 60th birthday, he plans to make equal monthly withdrawals from the fund at the beginning of each month. Right? From the 60th birthday, he is going to withdraw some money from the fund for 60 equal monthly withdrawals. 60 monthly withdrawals beginning from each month. So the first withdrawal beginning of this 60th birthday. So beginning immediately. So that means that is in the due as a due annuity. So then beginning from each month, there is going 60 monthly installment. So this is the case. So you are asking how much would be the balance here and how much will be the monthly installment. So these are the questions. So now I think this is correct. Only problem here. Now here, this is today 40th birthday. He's going to make 7,000 until he reach 55. You can read the question starting 1 month from today. Not immediately. So, next month I am making 7,000. I am making 7,000 until I am reaching to the 55. Otherwise, I think okay. If you have 7,000 or 15 years, so make a venas in this is make a due limit, make end of the month. This 7,000 you deposit end of the month. This is correct because at the 60th from the 60th birthday, beginning of the period, you are withdrawing 60 monthly installment. So this is annuity due. This is correct. The method answer is the make part right? The method answer is make it in 1.01, 180. Future value 1 plus r into the power 8 minus 1 divided by r. This method is 1.01 into the power 180 minus 1 divided by 0.1 into 7,000. 3. So you will collect 3.497 the method no. 1 month from today. Other is the mass. That is the meaning. 1 month from today, the ordinary payment. Beginning from today, 1 month from today, timeline calculate, other 0. So 1 month from today, next. Mistake. Otherwise, okay, I think. So, I will 1 month from today, that is next month. Whether uttare kiyadenne balanne 3.497 0.61 denne. So this is 3.4 million 97,061. Anitha these are fractions relevant to all. Right. ඒක හරියද බලන්න. Anyway, please check this. මේ answer එක right. එතකොට මෙතන ඉඳන් මෙතන මොකද වෙන්නේ? මේක නිකම්ම තියෙනවා account එක. That is correct. එතන මේ amount එක දැන් මේක වැරදි. This is 3.4 million 97,061. එතන මේකට interest එක compound වෙනවා for 5 years. That is correct. For 5 years, but monthly compound. So therefore that is correct. So again this answer may be wrong. Isn't it? This into 1.01 into the power 60. Isn't it? At the laksh, another make it 6.099. දැන් මෙච්චරක් මෙතෙන්ට at the 60th birthday එයාගේ account එකේ තියෙනවා 63,53,099 හරි නේද? එතන මෙච්චරක් තියෙනවා 63 million sorry 6.3 million 53,099. Now your monthly withdrawal එතන කියනවා ගානේ he plans to make 60 equal monthly withdrawals from fund at the beginning of each month. එතන මෙතනදී ආ මෙතනින්ම පටන් ගන්නවා withdrawal 60. මෙතනට මේක හරි. So then 60 monthly withdrawal එතන මේක වෙනස් වෙනවා. This should be 6.3 million 53,099. So යනවා මේ ගාන වෙනස් වෙනවා. What is the answer? Good. Anyway, the attempt is good. Next one. Here is the answer. Huh? 77,000. 77,020. You are withdrawing monthly 77,020. So your retirement plan? Your retirement plan? You can plan your retirement. Supposing interest rate remains constant like this, right? Come, let's go quickly. Right, question number 4. Come. 4, next. Yeah, get your amount 90. Susila obtained loan 1.7 million from Sampath Bank and is to be repaid in equal monthly installment where the interest is compounded monthly. And extract of the loan schedule provided by the bank is as follows. Susila has maintained good relationship with the bank and installments were settled on time. However, she has not been able to settle the last 5 installments. When settling the outstanding installment, a penalty of 2% will be charged by the bank on the total outstanding balance. If Susila intends to settle the loan fully, when she makes the final payment together with the delayed installment, what is the payment to be made in the final month? 4. Make it easy. හරි දැන් එතන ඔයාලගෙන් අහන්නේ මෙයාගේ ෆයිනල් පේමන්ට් එක එච්චරයි එක ආන්සර් එක. එන්න හොයලා ඒක. මම හදන්න 5 installments due වෙලා තියෙනවා. 5 installments මෙයා අන්තිමට ගෙවනවා with a penalty of 2%. Others you can read the question, na? Yes, that is correct. Installment is 24,390. Yes. What do I have to do? What is the location? What is the Five installment. This is the extraction of the amortization schedule. You are provided some extraction, but beginning from the first month, if you look at the amortization schedule, you can see it is starting from the first month because you are 1.7 million. So that means first month. This is a monthly one. So therefore, from that you can trace the interest rate. Interest rate එක trace කරගන්න පුළුවන්. ඒතර interest rate එක වෙන්නේ කීයද? monthly interest rate කීයද? 1%. That is correct. Because 70,000 1.7, so interest is 1%. So here Susila maintained good relations with the bank and the installment was settled on time. But she has not been able to settle the last 5 installments. මෙතන end එකක් හොයන්න ඕනද? මෙතන end එක හොයන්නත් බෑ. දැන් මේකේ කියන්නේ මෙතන මෙයාට last 5 installments මේ outstanding වෙලා තියෙනවා. Last 5 years කියන්නේ තව අවුරුදු භාගයේ loan එක ඉවරයි. Last when settling down settle the last 5 installment. Oh, installments she has maintained good and she has paid the settled on time. However, she has not been able to settle the last 5 years, last 5 installment. පහක් due වෙලා තියෙනවා. එතකොට මේ පහට දැන් මෙයා ගෙවලා නැහැ. ඒකට penalty එකක් ගහනවා 2%. එතකොට මෙයා කියනවා අන්තිමේට ඔක්කොම ගෙවන්නම් කියලා. So, question asked how much should pay? එන්න එකක් කොහොමද? දැන් මෙයාගේ installment එක වල හිතුවනේ කීයද installment එක? 24,390. 24,390 ගෙවලා නැහැ. 24,390 ගෙවලා නැහැ. 24,390 ගෙවලා නැහැ. මේකත් ගෙවලා නැහැ. හැබැයි මේ අන්තිමට settle කරන්න කියලා කියනවා මෙතන. එතන how much should pay? මොකද කරන්න ඕන? මේ ඔක්කොමගේ වෙදා තාරන් ගිහලා 2% penalty එකක් ගන්න දෙන්නේ. That's all. Then මේවා ගෙවලා නැහැ. 5 at the end of 5 months, end of next මේක පස්වෙනි මාසයේ අවසානයේ මෙයා ගෙවන ඔක්කොම. ඒතර එහෙනම් අපි මේ ඔක්කොගේ balance ටික මෙහාට ගෙනින්න ඕන. මෙහාට ගෙනල්ලා ඒකට 2% interest penalty එකක් charge වෙනවා. That is the answer. That is the answer. ඒතර මේක අපිට කෙලින්ම ගන්න පුළුවන් like annuity. Like annuity. So future value of annuity is equal periodic payment into 1 plus r into the power n minus 1 divided by r. So periodic payment is 24,390. Monthly interest rate 1%. So 1.01 into the power 5 minus 1 divided by 1%. For this, you have to pay 2%. So that means from this you have to multiply by 1.0. මේකට 100 දගා පෙනල්ටි එකක් ගන්නවා. ඒතර පෙනල්ටි එක මේකට එකතු වෙන්න ඕනේ නැහැ. 1.02කින් කෙලින්ම වැඩ කරපුවාම you have to pay that much. නේ? ඔයාලා කොහොමද කරන්නේ ඉතින්? මේක එන්නේ හොයන්නත් බෑ. අපිට පටන් ගන්නමක අවසානයක් දීලා නැහැ. last 5 installments ගෙවලා නැහැ කියන එක විතරයි කියන්නේ. ඒතකොට ඒ පහ අවසානයේ ඔක්කොම ගෙවන්නම් කියන්නේ. right? Very easy. Anyway, good. It is like that. Here are no fair. Anik question. Last, like the last නෙමෙයි තව එකක් තියෙනවනේ. මේ this one නේ. So this is someone is a sub-campus student. He decided to invest 500,000 in the savings account for his postgraduate studies. GF Finance offers annual interest rate 5% compounded annually. Someone plans to leave this investment untouched for 5 years with the goal of funding his education. A. Calculate the value of someone's investment after 5-year period. Calculate the amount of money someone has to deposit in DF Finance, which offers annual rate of 5% compounded monthly. If he end up with the same amount of money in about A. Right, first one, A. So this is annually, so therefore 1 plus r into the power 5. Right. Part B. Calculate the amount of money someone has to deposit in DF Finance, which offers annual rate 4% compounded monthly. He need to end up with the same amount. Divide by 12. Or 520, 2,638. Determine the nominal annual rate DF Finance should offer for someone to be indifferent between DF Finance and GF Finance. So DF Finance is a monthly compounded. GF Finance is the annual compounded. So to be indifference between these two, what is the nominal rate that DF Finance should offer? Good, eh? Right. So, part 3. But see, determine the nominal annual rate DF finance should offer for someone to be indifferent between DF finance and GF finance. The DF finance is which offers rate 4% compounded monthly. So that is not relevant there. So what is the what you have to do? So you have to calculate nominal rate indifference between these two companies. Now here, GF finance offer annually 5%. So therefore, you can write 500 you deposit into annual rate for the GF 5%. So 1.05 into. So you make 5 years. So this is the rate offered by the GF finance, 500,000. 1 plus R means 1.05 into 5 years. This is their annual nominal rate. If you write this one should equal to 500 into they are offering the monthly rate, so therefore 1 plus R divided by 12, this is 12 into the power 12. So this here this R and this one should be equivalent. So you have to identify දෙකෙන්ම එකම rate එකක් ගන්න පුළුවන් මේ nominal annual interest rate එක. Determine the nominal annual interest rate. Annual rate DF finance should offer for someone to be indifferent between the DF and the DF finance. That way you can calculate it. This is not the 12, this is the monthly 5 into 12, so that is 60. Okay? Monthly 5 into 12, 60. So now you can sort out. So here the value is 638,140 is equal. Make up main method again. 500 is equal 1 plus R divided by 12 into the power 60. So you have to solve this. A group so you can divide this 638,140 divide by 500 is equal 1.276 square root of 60 is equal 1 plus R divided by 12. Make it 60 1.276 is equal is 1 plus R divided by 2. Make a 0 0.040 R divided by 12. Make this into 12. So your equivalent rate between these two companies is 4.07. This is the rate. 4.07. So DF finance should offer 4.07. They are monthly compound. They are offering interest monthly. Monthly. So then you can you can check the answer equal. Monthly. So 500,000 into this is 1 plus. Make it this is make a 407 divided by 12 into the power 60. 1.0407 divided by 12 plus 1 into the power 60. into 500,000. Approximately, you know. 4.87 meters. So, like that, you make a color to correct it. Then 4.87 like that in meters. Make a super. Well, other than that, 4.87 then. So this is the way, right? Anyway, you can calculate this is 4.87. The 4.87 divided by 12. Yes. You are getting there. Make a 4.87 in it. So, perfect. This you can check. This is the answer. You make a method so you are getting this value. Right? You are getting this value. You know? The method when a method put a mistake. Right. Next one. Last. Oh, in it. You ready? Jagat. Jagat. Come. Jagat needs to buy a car. The vendor offers brand new car for 8 million. The vendor offers the option paying 10% as the down payment and the rest over 7 years in monthly installment. The bank charges 17% compounded monthly from professionals when personal loans are granted. Calculate the monthly installment if Jagat borrow the money from the bank. Determine the lump sum payment required if he needs to settle the loan fully at the end of 5 years. Make an extra amount that you can manage. That's then look at it. That's it. Jagat is the loan. Only thing there is a down payment. There is a down payment. Other than as earlier, you can calculate outstanding balance. So when there is a down payment, so what you have to do? So 8 million, brand new car at 8 million, but 10% pay as the down payment. So make it 10% pay and 800,000. So then balance is 7.2 million. 7.2 million. So now you calculate installment for the 7.2 million. The determine the lump sum payment required if he intends to settle the loan fully at the end of 5 years. This loan is going 7 years monthly. 7 years monthly and the total installment is how much? 7 into 12. Also clear? So the 7 years loans installments also clear. So after 5 years, you are going to settle the loan. Then after 5 years, in a way, outstanding balance is that's all. You can manage. So now we are going to the bond valuation. Any question? I'm not trying to discuss other question. It's up to you. You can look at these questions, try to do them. If any questions, you can ask in the upcoming. Now we are going to the bond valuation. Do we need a break before starting? It's 11. Break before 9. Continuous at 6 o'clock. Then, so now it is time to all right, 3:30 minutes. You may come with a break. 10 minutes, eh? 10 minutes. Listening now? Where are the listeners? Okay, where are the board? මට වතුර බෝතලයක් ඉල්ලගන්න. How many 10 minutes? මට මතක් කරන් 3:30 quiz එක දාලා තියෙන්නේ. එතන 3:30 15 minutes. එතන එක quiz එකයි. Time level we can decide and we will have it Friday. නැතු හරියන්නේ නැහැ ඔයාලා ගන්න. මේ වගේ ගණන් තියෙනවා quiz එකේ. right? So then හැබැයි මේ ඔයාලා මේ එළිය කරා කියලා මේ shuffle කරලා තියෙන questions, right? So you may, if you try to copy, you will end up with a lot. So therefore, don't try to copy. Total question bank එකක් දාලා අරන් තියෙනවා. සමහරවිට ඔයාලා questions උත් වෙනස් වෙන්න පුළුවන්. bank එකෙන් ගන්න. Multiple. ගණන් තියෙනවා. හදලා උත්තරය නම් මේ ටික කරන්න තියෙනවා. 15 questions, 30 minutes. Thank you. Thank you. Some students requested to do the quiz after 3 o'clock. The session will be conducted now, no? After the break. लेकिन आप लोग अभी क्विज से कर लेंगे। Around 2:45, shall we start the quiz? Listen. Answer there. अभी 2:45 तीसरे पटाया मैं टाइम में रजिस्टर So you can attempt to 45 quiz number 1. Right? Time addition and again 245. Can anyone check it? LM is okay. No? Don't try to copy. Don't talk to each other. Do it yourself because no point of copying because answers are being shuffled, right? So therefore, don't try. You can look at your notes book, anything you can refer, but do alone. 1 month issue I have informed them. You might not have in the lectures after 1 month. So, നാല് ദിവസം എനിക്ക് വർഷം election three dictators of issue. Finished. Out of 10. So you have to read more about the environment and the business, global financial market in your assignment also. Right. Now I will explain the assignment details also later. Now we are going to start the bond valuation. Bond and security valuation. So first we'll see the bond valuation. Before going to the bond valuation, uh, now you have learned time value of money. So you know the concept of value. You have learned to calculate value when you are receiving returns in the different time periods. You know how to derive, how to determine the value based on the present value and future value models using discount factor. So the things you learn in the time value of money, now we are going to apply in the security valuation and the bond valuation. And also this concept, this valuation concept, you can apply to value even the real asset, even the real asset or the business valuation. So we are using these models. So in this topic we will discuss the bond valuation. So on the next one we will the security valuation. So before going to the bond valuation, you should know what is this intrinsic value, because we are calculating here intrinsic value. Nothing new. Intrinsic value means simply present value of the future cash flow. So that is we call for an asset intrinsic value. If you are going to invest in the bonds, you can identify your expected cash flow. So then using some discount factor, you are calculating its present value. We call it as the intrinsic value. So knowing the intrinsic value is important when you are going to invest in the bonds, securities, preference shares, or likewise, because by comparing this intrinsic value with the market price, you can see whether this particular instrument overvalued, undervalued, or the fairly priced. Right. So this is the intrinsic value simply. So you can remember value. The model for the calculation of the value simply is equal, value is equal cash flow expected in some future date discounted using some discount factor. So this is the basic model for the value calculation. Now if you look at this model, now I am going a bit fast because we have completed time value. So you can see value depends on cash flow. And also there is a discount factor. So you can see cash flows are considered. So you know the difference between the profit and the cash flow. So we consider cash flow, right? So when we say the cash flow, it is free cash flow, not the profit. The timing and size of the cash flow affected to the value. Yes. So you can see here, this is the time. So you know that when the time is increasing, value is declining. That is the time value of money theory. When you have to wait long period to get a certain cash flow, its value is decreasing. Because you know that money received in earlier more valuable than money received in later. So therefore, timing and the value as well as the size of the cash flow affect into the value. So size, when you are receiving large amount of dividends, so value is increasing. When you are receiving large interest, so value is increasing because the size of the cash flow and the value is positively related. But here, time and the value negatively related. And also, the discount rate represents the investor's required rate of return. Now, in the time value of money, you define this as a discount factor. Right? When you are calculating present value, present value of the annuity, single cash flow, multiple cash flow. So we define this as the discount factor. Right? But now in the stock valuation, in the security valuation, we define this as the investor's required rate of return. You can see same variable, we are looking at the different perspective. When you calculate in the intrinsic value of the ordinary shares, so this is the required rate of return for the equity shareholders. When you are calculating the intrinsic value of the debentures or the bonds, this is the required rate of return of the debenture holder. When you are calculating the intrinsic value for the preference shares, so this is the required rate of return of the preference shareholders. You know that this required rate of return is different from financial instruments to instruments. This required rate of return is different from assets to asset. Because you know that normally, I think in the time value lesson also I told you, your required rate of return is equal theoretically risk-free rate of return plus risk premium. Required rate of return is equal risk-free rate of return plus risk premium. So this risk-free rate of return for your time value, the risk premium for bearing the risk. So this risk-free rate of return includes two components, real rate of return, so that is without inflation, rate of return without inflation, and expected inflation. Right? So the proxy for this risk-free rate of return, normally we are using treasury bill, treasury bonds rate of return. Because you know that this is we consider as the risk-free, these treasury bonds, treasury bills are issued by the government. So normally, theoretically,